Well, good morning, everybody. As Matt said, I'm Gordon Kearney, the Managing Director of Fiducia. I'd like to thank Blackmore for giving us the opportunity to speak today. And the interesting subject I've been given is, what has COVID-19 changed and where should I invest my money? Okay, health warning. Here at Fiducia, we have no crystal ball. We certainly don't have a time machine. However, we are very fortunate that we do have Michael Hughes. Michael is a stalwart of the city, having spent 35 years in significant posts, including Barings, JPM and Barclays. He's been with us for 12 years and he helps map out the economic framework here at Fiducia. So, void of a crystal ball or a time machine, he's our next best thing. So the question is, what has COVID-19 changed? And I think the answer to that is quite a lot and very little. Clearly, it's without precedent in terms of the impact it's had on us as a society, but also on the economy, and also the extent of government control in our everyday life. However, from an investment point of view, we see it that very little has really changed. There still remains the need for a good, well thought out strategy and plan. Within that, there still needs to be a strong, well thought out long-term economic and investment strategy. And within the heart of that, there needs to be diversification. Not particularly exciting, but it is the bulwark of good investment management. So if we touch on investment diversification, what we see here is quite a common chart in investment management, but it demonstrates the top performing asset classes. This is a US version going back to 2006. So that's a good reference because we have obviously the crisis and the recent crisis of 2006, 7, 8, all the way to COVID-19. And it's a very colourful chart, but in essence, what it's showing is that it's virtually impossible year on year to pick the best performing asset class. You can see quite clearly that REITs, which is the top in sort of 2010, 11, 12, and then 14, 15, is also now the bottom performing asset class. So commercial property, while the darling of the sort of 10s to the 15, has quickly fallen out of favour. And equally, look at the one with markets. It's essentially, it becomes top, then bottom, top, then bottom. The point here is that diversification is about ascertaining that sort of middle line. So if you look at the white box, which is an asset blend between various 7 asset classes in the chart, you can see it's not exciting, it's middle of the road, but it produces a degree of predictability that you can't get from trying to pick winners of the future. So the first message is that asset allocation is as valid today and diversification as it was pre-crisis. But if I take a look at specifically Fiducia's forward-looking investment strategy, and to ascertain what has COVID really changed in terms of the way that we view the world. Now, pre-crisis, our model portfolios, in conjunction with Michael's insight, really looked at these 7 key themes and said, well, we want to build a portfolio for what the world's going to look like, not necessarily what it has looked like. And if I look at COVID through these themes, and I can see that really it's fast forwarded certain trends, but specifically these 3, which I'll go into one by one. So it's the debt growth trade-off and what that means for inflation, the demographic trends that we're seeing and what the impact that has on technology and healthcare spend, and the significance of global emerging markets, but more specifically the rise of Asia. So the point I'd like to stress here is these were existing themes that we had. So if we look at it to say, well, what are these themes and then how has COVID impacted them? Well, it's quite clear to us that in the West we have a debt overhang. And the only way, well, there's 3 ways you can get out of sort of debt in terms of government debt. And the first one is economic growth. But as you can see from the chart on the right, this is a McKinsey study looking at average rates of global GDP growth. So the 1950s to the 14s were a golden period. pre-COVID, the period from 14 to 64, that sort of 50-year period, returns were projected to come down as the Western world slowed, and unfortunately the developing world couldn't pick up the slack. So it was quite clear to us pre-COVID on a 10-year view that we've got debt and we're not going to grow out of it anytime soon. So the next question is, well, what else can you do? Well, you can default. And this is what Argentina has been doing perennially for the best part of a couple of decades now. But to the Western world, that's undesirable. It's just not palatable that someone like, you know, in the Eurozone or indeed the UK. So we identified that on a 10-year horizon that inflation was the only way that the government debt and the overhang on the West was going to be eroded. And hence we modelled our portfolios accordingly. So if we look at what has COVID done, well, it's self-evident from looking at the papers and the projections that there's been a huge hit to GDP. I mean, the baseline at the moment is for 5.2% contraction of global GDP. Essentially, it's going to be the deepest recession we've had in decades. So if we weren't going to get out of it with growth before, we're not going to get out of it with growth post-COVID. So that leads us to inflation. And there are a number of inflationary points that really add up to the previous point about how we're going to get out of it and the long-term view. And one of them is that if COVID's taught us anything, is that we have to assess our dependence on China. You know, is China a reliable partner? I think the question to that is no, or the answer to the question more of is no. And therefore, what we're going to see, and we've already seen evidence of this, is shortening of supply lines. You know, countries and companies are onshoring where practical or indeed cost effective, or indeed they're moving to less politically volatile countries than China, for example, Vietnam. The net result of this is that labour costs are more expensive, and therefore that ultimate cost is going to be put onto the consumer. So if we look at the role of China and pre-crisis, we had obviously the rise of protectionism, which is really calling into question you know, globalization as we've come to knowing and enjoy it. And I think it's evident to say that COVID-19 has really heightened the sensitivities around our dependence on China and indeed globalization. And globalization has had a huge deflationary impact over the last two to 3 decades on the world. And I think that's now being assessed, which in itself, I believe, will be an inflationary pressure. We're going to see tax increases. Initially, we've not seen any tax increases. The obvious reductions were in VAT to help with the hospitality sector, but eventually they will revert to the norm, and simple baseline effect of tax increases in the future will lead to inflation. There will be more indirect tax increases because ultimately the burden of debt that we've accumulated has to be paid for. As an aside, the government in the UK is forging ahead with its digital tax on the likes of Google and Amazon, but these companies have essentially said we're going to pass that on to the consumer. So there are, you know, in addition to COVID, there are other stresses that are causing inflation. Cheap lending and government schemes, stamp duty, help to buy, they're all serving to inflate the property market and all the ancillary services that come off that. Where will that end? I truly don't know, but I think at the moment it's quite evident that it's inflationary. We've had more quantitative easing. Essentially, the government's looking to reflate the economy, but essentially, again, that is a sort of stimulation of inflation. And if we add into that the B word, Brexit, we're either going to have a skinny deal or indeed a hard Brexit. But either way, there's going to be tariffs in both of these scenarios, and tariffs by their very nature are inflationary. So we view that inflation is on its way, but the question is, on recessions deflationary? And it seems silly to say that inflation is on its way when you've got all of these structural headwinds. But I'd like to encourage you to think of it like the Nike logo. And what I mean by that is if you consider the tick you have today and 12 to 24 months, in the short term, you're going to have greater unemployment, suppressed demand, lower business and consumer spending, and tax cuts. However, over time, whether or not it's 24 or 36 months, you're going to have all those aforementioned points come into play, which are going to push up inflation. So I think we need to prepare our portfolios and have a view on inflation coming into the system. And from within that, there will be some beneficiaries, property, albeit a huge question mark over commercial property as it stands in London, etc., and retail. But traditionally, real assets do well when there's inflation. So things like infrastructure, commodities, particularly gold. If I move on to another of our pre-COVID-19 10-year views and themes, and that was really the demographic trends, that as China's getting older, as the West is getting older, there's certain parts of the world and the US to a lesser extent that will benefit or will need, moreover, greater expenditure on healthcare. We have some other working assumptions there, but specifically for today, I'd like to focus on the expenditure on healthcare and indeed technology. The two essentially are intertwined and will need to be to service the amount of the populace that is getting old. So pre-COVID, to us, this was clearly a theme that we wanted to have exposure to. You know, how has COVID impacted this theme? Well, I think it's evident to say that, you know, COVID-19 has been a wake-up call. The realization that the economic costs of the pandemic can be huge, far surpassing investment in research and prevention. The reality is we will now, as a planet and as particularly as the Western world, we're going to spend billions on research, vaccines, therapeutics, and non-medical methods of prevention. Essentially, populations will now put a premium on healthcare. We all now appreciate more so than before and value our healthcare, and that will lead to greater government spend per capita, which will be publicly and politically acceptable. So we see a real boon, and to use a deliberate pun, healthcare will be put on steroids as an investment asset class. But it's not just healthcare, it's technology. You know, 10 years in 10 weeks, you know, from Zoom to Netflix, to online shopping, to the way that we operate in the office, from DocuSign to the Teams, which we're using today, to cashless payments. You know, COVID-19 has essentially put a fast forward button on technologies that we would have adopted when we were ready. So the result of that short, crazy period of technology embedded itself in our lives was that tech companies, unlike 1999 and 2000, they've got solid earnings, and in some instances, huge earnings. Some of them are quasi-utilities, if you think of Google and Amazon, and essentially they've been embedded into our lives. However, while we believe that technology is a key theme and a driver of markets going forward, I would exercise a degree of caution. Valuations are extremely high. This may be valid in the likes of the quasi-utilities, but not all stocks are utilities. So if you look at something like Spotify, it's got a high price to earnings, and it's got huge challenges from the likes of Google and Apple, which will, I believe, erode at its market share and ultimately depress the valuation from what appears to be an excessive high. Likewise, Netflix. Netflix was the lead, if you will, in terms of embedding itself in our houses during the lockdown, but this got some huge challenges. On a price to earnings of nearly 80, it's got the likes of Disney and Comcast, which are snapping at its heels for that market share. And also, we mustn't forget that political sentiment towards Silicon Valley can change. So our message here is that while we believe that technology is a key theme for the future, you need to be careful, don't get carried away, diversify, be proportionate in your allocations. And ideally, what you want to be looking for is the next set of FANGs. That's where the returns will be, not necessarily in the monoliths that we see in the likes of Google and Amazon. The final theme I'd like to look at today is the rise of Asia, but also generally globally emerging markets in general. So again, carrying on my theme, what we've got here is our pre-COVID theme. And if you look at the right, this is the essentially the top 500 companies, or the Fortune 500 as they're dubbed. And these were projections pre-crisis. So you're looking at a slow and steady increase up until sort of the 20s, until 2025, of Chinese companies being populous in that bar chart. And you can see that essentially it's roughly about 45% they're making, 46% that they're projected to make up. So again, key theme, we saw it developing, and I think this is also reiterated if you look on the left. Again, it's a McKinsey study, but it really shows essentially where the economic output and the significance in terms of cities will be projected in sort of 2025 and beyond. If you look at the transparent ones, you see essentially these were significant cities in 2007, which won't make it to 2025 in terms of its GDP, its economic output. And it's quite clear to me, looking at that chart, that there is a proliferation in Europe of has-been cities, for want of a better phrase. Some cities will remain significant, which is essentially your orange ones. But what's most striking is the blue ones, and that is the proliferation of new significant emerging market cities, predominantly along the eastern seaboard of China, but into Asia as well. So you know, it's not a new story. Asia was rising. It was you know, it's got a lot of demographics in its favour. It's got the GDP. It's got the momentum. So it was a theme that we had within our portfolios on a long term and a tactical play. But you know, COVID. So how's COVID impacted this theme? Well, if you look at the GDP year on year of the top performing nations, and indeed the worst performing nations, what you see quite clearly is the likes of Bangladesh, China, Pakistan, Vietnam, Taiwan, and South Korea. These were, you know, some of the first nations into the pandemic, and they're clearly, from an economic growth point of view, going to be the first out of it. The converse of that is if you look on the worst performing economies, notwithstanding India, which obviously has a huge issue with COVID in itself, you see the United Kingdom, Spain, France, Italy, and down at the bottom, the Euro area as a whole, as really struggling on a GDP year-on-year basis. So to us, COVID has accentuated or fast-forwarded the trend or the theme that was emerging Asia, which essentially means that they're going to catch up the West quicker. And in terms of global significance, Asia will be a key driver of economic growth going forward. As you can see, the beneficiaries. So it's not all about the putting all your investments in emerging Asia. There are other ways that you can play this by Western consumer brands, indeed infrastructure and commodities. So in summary / conclusion, COVID-19 has changed a lot in our world, but it hasn't changed the need to have a plan, to have a long-term investment strategy that looks at where returns are going to be, not necessarily where they have been from, but you still need to diversify to protect portfolios from the ravages of ups and downs. And in addition, there are some clear winners within investment strategies, but you have to be minded of inflation. You have to allocate potentially to healthcare and technology, albeit with the caveat of being proportionate and not get carried away. And also looking at the significance of Asia and how you can play that within your portfolio. Hopefully that's given you an insight as to how we look at our portfolios here at Fiducia.